Hi, and good morning. Welcome to our live quarterly market update, where we share insights to help you as you think about markets and investing. I'm Katie Brown, and I'm here with Dennis Morton and Cody Dummel this morning. Hi, guys.
Good morning.
Hi, good morning.
So, by way of introduction, our vision at Morton Brown Family Wealth is to be a positive influence on the experience that people have with money, relationships, and life. So, with that in mind, we hold these sessions so that our community can stay informed about the market environment. I see a lot of familiar names here this morning, a lot of familiar people. Thank you so much again for tuning in. And for those of you that are new, thank you for tuning in. We try to keep this as an interactive session, and we want to make sure that we are answering your questions to the best of our ability. So as you have questions, or if you simply want us to go deeper on a particular topic, please feel free to use the chat below, and we'll do our best to make sure that we get back to you. With that, we have a lot to cover this morning. So Dennis, why don't you kick us off?
Thanks, Katie. All right, so the last few years have been historic and frankly, at times exhausting. I mean, we talked last year a lot about the direction of things was nothing new. We've had recessions, we've had interest rate cycles, but the fastest recession, the fastest recovery, the fastest inflation, the fastest interest rates, that speed created a lot of confusion, a lot of anxiety for investors. And then came the fourth quarter of 2023. And just to get a sense of what happened in that fourth quarter, if you were a balanced investor, so say you had roughly 60% of your money in stocks like the Russell 3000 and 40% of your money in a bond index, the US bond index, your returns by the beginning of November were probably in the low single digits. Then in the next 8 weeks, everything just bounced back. And you probably ended up the year in the double digits, almost 2 years worth of average returns in an 8-week period. Frankly, if you blinked, you missed it. If you tried to time it, you probably didn't catch it. So we just want to start here by stepping back and saying, if we had to think about what we've learned in the last few years in this microcosm of booms and busts and cycles happening so fast, what can we learn that make us a better investor? And first we start by looking at the past. And we want to be careful when we look at the past. We want to understand it, but we don't want to look for patterns. We want to take the information that we gain and recognize that in the short term, anything can happen. Remember in 2020, we had a global pandemic that hit us in the first quarter and still ended up with positive returns in the stock market by the end of the year. In the short term, anything can happen. When we look to the future, we want to think about being an optimist. Again, maintaining that long-term view that in the long term, generally things move up and to the right. We're going to see that theme kind of recurring as we move back to historical averages on a lot of different market segments. But we want to maintain that optimism, which was really scarce last year. We talked about sentiment surveys. We talked about what we were hearing from our clients and out there in the marketplace. There was a lot of negativity, but optimists were rewarded in the fourth quarter. So that brings us back to the present. What can we do in the present to make sure that we're being the best investor we can be? And truthfully, it's a matter of being unemotional, almost stoic and detached in the way we evaluate things. If we let our emotions get the best of us, we end up checking our balances all the time. We end up chasing short-term performance, which we'll talk about that a little bit too, how the temptations have been there in different places. The more we can remain unemotional in the present, informed about the past, and optimistic about the future, I think that's what's been rewarded here in the last few years as the markets have started to recover a little bit. So let's talk about where we are now. Cody, I'll turn it over to you.
Yep. So as always, we'll go over some positive signals that we saw last year and then going into 2024, and then just some potential, concerns going forward, or just some, aspects that may, pop up and bring some volatility in the stock market. So some of the positive signals going forward, as Dennis said, it was a very strong year last year for investors overall, even with all the noise that we heard over the last year. So obviously the Fed still continued to raise interest rates last year, but we had a positive return both on stocks and on fixed income last year. Inflation continues to come down, getting closer to the Fed's, long-term goal of a 2% inflation rate. They're still sticking to that, so hopefully we get closer and closer to that 2% as fast as possible. There's more income from fixed income, so the yield that you're getting on the fixed income market is a lot higher than what we've seen over the last couple of years, especially just looking back to 2020 when interest rates were pretty much zero. So now we're actually able to pick up some yield from fixed income going forward, which is obviously always positive for investors. So some of the potential reasons for concern going forward. Last year, a lot of the returns were driven by just a small number of stocks. So the largest 7 stocks inside the U.S. stock market did a lot of the heavy carrying last year in the overall returns. But we will go deeper into some of the other stock market areas that also had a positive year last year, just not as positive as some of the other magnificent 7 stocks. There's still a lot of geopolitical risks that lurk around the world. Obviously, there's still world wars going in Ukraine and the Middle East. Obviously, we have a huge election year here inside the U.S. And then one other potential concern is it's still possible that inflation could stay a little higher than that 2% Fed funds rate, and they may have to keep interest rates higher, like where they are right now, or potentially have to raise interest rates going into next year. That's not exactly what we're thinking, and we'll go over our thoughts in a little more detail going forward, but just a potential concern going forward.
You know what, Cody, I love that. Thank you for highlighting some of the positive signals and some of the concerns. And I think it would be very easy to latch onto any one of these items or any combination of these items and try to put that together into a prediction of what's going to happen in the future and going forward. But the reality is there's too many unknowns, and anything can happen in the short term. And I think that's been proven over and over and over again. This next slide that we wanted to share talks about exactly that. So this is looking at the forecasts from the last 5 years. And these are really, really smart people at very large institutions with teams behind them, putting together their best forecasts for what could potentially happen in the year ahead. So we're looking at perspectives from, JP Morgan, Goldman Sachs, Morgan Stanley, Bank of America, you name it. And bringing it together, we can see in the blue being what the estimate was for returns in any of these given years. So in 2022, up 1%, down 21%, or I'm sorry, 21, up 1%. But the estimates, though, for where the returns were and where we actually landed in the markets over that 5-year period, they range from being 26% too low, as we had here in 2021, and 21% too high, as we had in 2022. So to try to guess where the market's going to be in any particular given year, it's really not possible. There's just too many unknowns. And we get that question all the time. What are the markets going to do? We have to go back to the trends. We have to use sort of that past information to be informed and make informed decisions going forward, but it can't be in a microcosm of time.
Yeah. So in other words, if you're feeling confused, you're not alone. Just those last 2 years, that gap, it's everybody. And Katie, we talk about anything can happen in the short term. Anything can not happen too. Like we were talking about the likelihood of a recession last year. Where was it? It didn't show up. People, if you try to prepare for that thing that you think is going to come and it doesn't happen, that can be equally catastrophic for your plan.
Exactly. Yes.
All right. So let's talk next about what was the real story. The recession wasn't the story necessarily, but over the last 2 years, it was about rates. Recession didn't show up. This is the 2022-2023 path for the Fed raising interest rates. And when we talk about the real damage that was done in 2022 for investors, there was just as much that was happening in the bond market as there was in the stock market. We appreciate that bonds are a less understood element of an investment portfolio. We've come to learn that over the years. But when interest rates go up, bond prices go down. So this dramatic rise that you had, that pace of those stairs going up in 2022, that created a massive downdraft in bond prices. But it was the Fed trying to tamp down inflation. It was that, trying to respond to one fast-moving object with another fast-moving object. Last year, it leveled out. And what you see here is by the time we got into July, the Fed started to signal that they might be done, that they may have done enough in the near term to keep inflation on the trajectory down and to keep things, to manage expectations. So when we talk about speed and pace and the pivot, this is as it approached the end of the year, the market became more convinced that the Fed was done. And that's when things started to take off at the end of the year, because suddenly the pace was slowing down, the pause was in place, and a pivot to lower rates was starting to be talked about. So the bond market started to rally, the stock market started to rally. So we heard a lot of concerns over geopolitics and domestic politics and a lot of other things, the recession, a lot of other things the last few years. But rates were really the story. And I would put this as another positive, if we did at the beginning, is that if a recession were to come, if we were to have a slowdown in the economy now, at least the Fed has tools at its disposal. When something bad happens in the economy, one of the Fed's first responses is to lower interest rates. Back here in 2022, if a recession had come about at any one of those places, they didn't have much room to wiggle on that. Now they do. And if they lowered interest rates, that would be a benefit to you as a bond investor if you have a diversified portfolio. So there's a lot of, as Cody mentioned in the beginning, higher rates add a lot of stability into a financial plan if you can get through the tough part about the rising rates.
Yep. So speaking of that, we'll look at the global bond returns for the fourth quarter and then also looking at the full year for 2023. So one of the things that we wanted to point out in this chart, so the chart on the left side is just the fourth quarter in 2023. So just the last 3 months. The chart on the right side is the full year. So kind of going back to what Dennis just went over of how fast interest rates, were going up over the last couple of years. Even though the Fed did not cut interest rates in 2023, there was a drop in the 10-year Treasury. So the 10-year Treasury hit 5% at one point, and then as Dennis was saying, the Fed kind of paused. It's still paused right now, and the expectations are potentially to cut at some point in 2024. So we saw the 10-year Treasury drop from 5% to 4%. So 1% move in the 10-year Treasury had a very strong return for the fixed income environment. So if we look at the yellow, orange/red, and the black, those are all the intermediate term bonds. So the muni bonds, the corporate bonds, and the international bonds had a very strong return in the fourth quarter of almost an average of 7%. And that's just because the 10-year Treasury dropped 1% in interest rates. And if we look at the full year, even though the Fed still raised the interest rates 1% for 2023, we had a positive return throughout the fixed income market. The one fixed income portfolio that was actually negative for 2023, which we're not showing in here, was long-term corporate bonds and government bonds. That was still a negative performer for 2023.
Yeah, and that just speaks to the impact of those rising rates. Yeah. Go ahead, Katie. Sorry.
If the labels were not on this chart, you can mistake this for an equity chart.
Yep. Yes.
Especially in that fourth quarter there. I mean, those are very strong returns. And when we think about, there's so much conversation around high yields on money markets and buying 3-month T-bills, 6-month T-bills. And if there's a particular need in that time frame, that's a great solution. But for a long-term strategy, a lot would have been left on the table.
Yep.
Shifted
yeah, so I know Dennis is about to go through a chart on that, but that just is speaking to being invested, locking in some of the duration and yield that you're getting on the fixed income, like the bonds. And we obviously saw that in the fourth quarter, even though the Fed didn't cut interest rates. I mean, if you just look at the red chart, the intermediate term corporate bonds getting 8% in one quarter without the Fed even cutting interest rate is, obviously great.
Eventually, the Fed starts pushing on a string. Like the Fed's trying to influence things and pull down interest rates, and they can exert a lot of influence. But eventually, the market takes over and starts to anticipate and try and do. That's what we saw really in the fourth quarter. And also, Katie, you're exactly right. If you go back to that on that previous slide, you had the analyst expectations. Mm-hmm. They were like in line with bond portfolios. It's so true that for last year they were calling for like 6%, and there it is in the aggregate bond. So it's just, all right. So let's talk about another hot topic from last year, which is cash, money markets, CDs, short-term instruments to earn yield. Frankly, we had to dust off a few playbooks last year. We hadn't been talking about higher yields since 2007, 2006. It really hadn't been the state of things. But now we're starting to see things like money market yields started to come back. There's a story in the Wall Street Journal this morning about, if the money market, phase is over for this particular type in the market, what do you do now? We're going to talk a little bit about how to earn yield and where to earn returns in income producing instruments, specifically bonds. What this chart shows you is the last so many, call it 6 or 7 interest rate cycles leading up to a Fed pause. So the dotted line here is when the Fed paused. To the left of the line is bond market performance in the 12 months before the Fed pause. And then you have the returns 6 months after, 12 months after, and 24 months after. So on average, the bond market was up about 3% before, in the 12 months before. And then in 6 months after was up 8, and then 13, and then 25. We're already seeing that play out a little bit in that we talked about in the fourth quarter, shortly after that pause, suddenly all those returns that you saw that Cody showed you, a good part of that was just price appreciation. You were getting sometimes 4 or 5% price appreciation in certain bond categories just because interest rates were coming down by market forces. So the takeaway from this is that a lot of your returns for the next 12 to 24 months are coming in the first 6 months after, coming in the first 12 months after. So you have to kind of be in that market. So if you're sitting on a money market account or on a short-term CD, you face reinvestment risk that you could be reinvesting at lower rates, whereas in a bond portfolio, you can capture yield, whatever it might be, depending on the instrument, 3-4%, but then you have the price appreciation if and when rates come down. Historically, that's been the case. So I think it's important. We talked before about the plan should dictate how much cash and liquidity you need for short-term needs. And then all the other pieces should be built into an intermediate and longer-term strategy, of which bonds could and should be a very important part.
Yep.
Yeah. All right, let's get back over to equities here again for just a minute. So we had a very strong year last year in the equity markets as well. We actually had a strong year in both fixed income and equities. US stocks, if we're looking on a year-to-date basis, US large cap stocks led the way again last year. But then we still had really strong returns internationally. We had strong returns in international small caps, as well as US small caps and also emerging markets. We were positive across the board. So a diversified portfolio really played out in different ways at different times, but really contributed well to the returns last year. And I think one of the areas of that, to me, when I look at this, that really jumps out to me is especially in US small caps. So over on this side, we're looking at the fourth quarter returns versus the year-to-date returns. It was a tough year, the first half of the year for small cap stocks. The first half of the year, you were spooked by some of the banking crisis that happened and how that just kind of, it was a lag for small caps for a while. When we were looking at going into the fourth quarter, we're sitting at pretty much zero. Small caps basically made up almost all of their returns in the fourth quarter of last year. If you would have abandoned the plan, you would have missed that pop that happened there. And we see this at different times, different things are going to contribute in their own way. And it's really important to maintain that diversification and also to recognize, Cody, you touched on the Magnificent Seven earlier today. So that was, 7 stocks really driving the US stock market. And those stocks change over time. You can't just latch on and say, okay, these are going to be the best performers, because they will change over time. Mm-hmm. But something that we do pay attention to is in the US, we tend to have a handful of very strong drivers, but internationally, the markets are much more, they're equalized in that average company is contributing an average amount to the markets. It's not one company contributing hundreds of percent return that's pulling everything else. And so we like to keep that in mind as we think about international investing versus US investing and how they contribute in different ways.
Yeah, it's even within asset classes, if you look back over the last few years, you could have felt silly owning one of the leaders for next quarter.
Yes.
because everything, cash was so out of favor in 2021, and then 2022 it was what saved everyone. But tech was not. 2022 was a terrible year for tech stocks. And yes, they've recovered, but it's hard to not take the bait.
Yes, but they haven't even all fully recovered. I mean, if
Right.
we look at if you look at Amazon, for instance, and this is not a knock on Amazon, because I'm telling you, I probably can't live without Amazon. But if you look at Amazon, it's one of the Magnificent Sevens. It's one of the top performers now. When we think back to the FANG days, it was one of the top performers then. But in the middle, it really wasn't. It got slammed in 2022.
Yes.
And so if you said, all right, I'm going all in on Amazon, over the last 3 years, you would actually be negative. It's negative down around 5% or so right now over the last 3 years rolling. So you can't latch on to one specific strategy and say, this is going to be it.
Yes. Hey, we have a question in the chat box. I think that might be a good time to address it because it focuses on a couple of the most recent slides. So the question is, with the last chart on the Fed pause, is it a cue to possibly move the balance of stocks and more into bonds? So it's interesting. This was a timely thing because there was an article in Wall Street Journal just this morning that cited a study by the Royal Bank of Canada over the last, 70 plus years. Actually, from 1950 to 2021 was the data set that they had. And they said that the S&P 500 hit 1,000 record highs between 1950 and 2021. Only 7% of the time did they was the market in a correction 1 year later. And if you push it out to 10 years, the market was negative exactly 0 times. So when we think about, we're getting the question, okay, markets are at all-time highs. Should we be looking at bonds? Or bonds more attractive? There's been so much turmoil that I think rebalancing on the margins makes sense, but I don't think it makes sense to make any major moves one way. I think the plan should dictate that. If you're an income-oriented investor and you say, I don't need to take the risk anymore, I'm in a different season of life, that's a question to revisit your financial plan. But there's a compelling case, I think, to be invested in stocks, both domestic and international, a compelling case to have fixed income exposure. I just think it shouldn't be, if you still feel as though you're in an extraordinary position, like I have a lot of cash, I'm sitting on a lot of stock or a lot of bonds, now is not a bad time to revisit that extraordinary position. But if you're thinking strategically, do I make this move because there's a better opportunity? You have to be careful what you're trading out of.
Yeah.
Does that make sense?
Good point. Yeah. I think that kind of goes to the next chart we're going to bring up that looks at the valuations of US stocks, international stocks, so both international and emerging market. So what we're looking at here is the price per earnings. So the price you're going to pay for the earnings of the average stock inside of these index. So on the left side, we're looking at the US, then we have Japan, Europe, EM, and China. I think the most important thing to point out is back the last time we hit all-time highs, besides right now inside the US, is this dark blue dot. So the current valuations are actually lower than where we were prior to 2022. So the valuations are actually still better than the last time we hit all-time highs, both inside the US and international markets. You can make the argument that maybe US is a little overvalued. So the purple line here is the average price per earnings for the stock. So US is a little above the average earnings, but again, that could change if earnings come in stronger than what the expectations are. But this also goes back to, this is why we want to be diversified, both in Europe, international, Japan, EM. They are all below the average 25-year valuation for the stock market. So there's definitely opportunities outside of the US, and even inside the US, it's different between large cap and small cap. Small cap have much better valuations compared to large cap based on the expectations for the earnings. But again, if a company beats their earnings, then their actual price per earnings is lower. So these are just estimates based on the analysts that they're giving to the average stock inside these benchmarks.
Excellent. We would talk about these cyclical rotations. I mean, it takes these move in big, long, sometimes decades long movements in and out of favor, where things are favored. But at different times, you've been rewarded for being globally diverse, size diverse, all those things, and maintaining. So lots of stuff has been working at different times in the last 12 months.
Yeah.
All right. We would be remiss in an election year if we didn't talk about politics and investing. And, I think what we want to do here is we want to squint our eyes and zoom out. Because if you just squint your eyes and let the numbers pop out, it's kind of like the Callan chart that we'll show you here in a minute. There is no pattern. When we look at, the historical cycles going back to the early 60s, from Kennedy beyond. And historically, there's been very little correlation between presidential cycles, political cycles, changes in leadership, and market performance. You talk about if your political inclination was to the R side and you decided not to invest during the Obama years, you missed an annualized 14.5% per year during that time. If you lean more to the D side and decided you didn't want to invest during the Trump years, you missed annualized 16% during those. There are so many factors that impact investments. We just spent a lot of time talking about the impact of the Federal Reserve, the impact of economic forces that sometimes have a policy influence, but many times are impacted by a lot of things out of control. The other thing is, and it's something important to bear in mind, coming off that international slide that Cody just showed, a lot of the things that we've been worried about, things like inflation, economic growth, all those other things, if you look across the globe to developed economies, they've been going through a lot of the same things, the same spikes in inflation, the same downdraft in inflation, the same policies on interest rates. So there's a lot of things that are happening around the world that go beyond our borders. So we'll be talking more about politics as we get closer to it. The things that I think we pay more attention to is, what does it mean from a planning perspective? What does it mean for personal impact on taxes, or even Congress, their willingness to tinker with retirement planning in the last few years through the Secure Act 1 and 2. So those types of things are much more top of mind for planners like ourselves.
Yep, good point. So as we said earlier, and we don't want to make predictions going forward, but one area that we can be pretty positive on and have a good outlook going forward is fixed income. So what we're looking at on this chart is looking back over the last 50 years at the blue line, which is the average starting yield that you're getting on the aggregate bond index inside of the US. And then the green line is the average return over the next 5 years. So for an example, if we look at 2000, the aggregate bond index was right around 8%. So the yield you were getting on fixed income was around 7 to 8%. The next 5 years, you can see the green chart, or the green line, is right at 8% too. So you got annualized return of right around 7 to 8%. You can see there's a 94% correlation between the starting yield that you're getting on fixed income and the average return you should expect over the next 5 years. So now looking at the current yield for fixed income at around 4.5%, that should be a good starting point or expectation for fixed income annualized over the next 5 years. Obviously, there's going to be some years like last year where the intermediate term bonds were up close to 8% or a little over 8%. And then there may be years where it's flat or potentially down a little bit, just depending on what the interest rate environment does. But this should be a good starting point for expectations going forward on fixed income.
That's a good differentiation, Cody, because fixed income is such a different market from equities, just by nature of how it's structured. With you lend money, you get money back plus interest.
Yeah.
There should be some more correlation around that when we think, and obviously no guarantees of returns, but we do our best to be informed from the past and to prepare for the future, with the information we have, and that's all we could ask of anybody. So that's good. So I think it's also important, we've had little comments popping up throughout this session as well, but to not lose sight, or to keep that focus on what really matters. And truly, it has to start with your own personal family's plan. It has to start with what are your goals? What are your timelines? All of that feeds into, or all of that helps to inform the investments that are needed to help support that. And that's so keeping that concentration and taking the time to zoom out and say, okay, how are we doing? How are we trending? What does this look like as we have looked over the last number of years, and we kind of forecast that going forward with the information known while you maintain that flexibility. I mean, that's the important thing is really taking kind of that disciplined approach to let's make sure that we're setting the stage for things in our favor. So we have flexibility later. We've saved for the unknowns. We're preparing for the knowns, and we have a little bit of humility along the way. And also just, focusing on
that's a great focal point, Katie. And I think one of the things that if we're looking for a positive in the future outlook, if we're to take something from being at or near all-time highs in U.S. domestic stock market, it's that we've been through another hard thing and come out right back up to the top. And it's happened over and over and over again in our investing lives. And it's important to remember that happens and to bear that in your mind next time there's a crisis, to say, let's make sure we have a plan and that we can maintain that stoicism and that calmness, knowing that things are going to be, they will come back, they will recover.
Here we are.
All right, so thank you all. Yeah, we're right on time. Look at this. Punctual. All right, well, thank you for joining us. If you have any follow-up questions, if there's something you'd like us to go deeper on or a concept you'd like us to address in a future discussion, let us know. We love having you all here. Thank you for being part of our community, and we look forward to catching up with you in the next quarter.